Opening an investing app to execute a trade initiates the acquisition of a literal, fractional ownership stake in a corporation. That single slice gives you rights to a portion of the company's profits and a vote in its governance. Importantly, your liability as a shareholder is strictly capped. The maximum amount of money you can lose is exactly what you paid to acquire that position. However, as an owner, you are legally classified as a residual claimant. If the company liquidates or distributes earnings, the employees get paid first, then the suppliers, then the bondholders. You, the equity holder, are last in line to receive whatever cash remains. Being at the bottom of the capital structure introduces distinct risk, because in a bad year, there might be nothing left to claim. But it simultaneously provides unlimited upside. Once a corporation's fixed obligations are met, every additional dollar of profit belongs to the shareholders. Because of that added structural risk, shareholders demand a return on their investment. This return arrives through two mechanisms: ongoing cash dividends paid out of the company's profits, or a capital gain when you sell your share to another investor at a higher price. To understand if those individual stock gains are part of a broader macroeconomic trend, analysts rely on market indexes. These act as centralized scoreboards, aggregating the performance of specific groups of stocks to gauge the overall market's direction. The oldest and most famous of these is the Dow Jones Industrial Average, tracking 30 large U.S. companies. It uses a price-weighted methodology, meaning a company with a higher individual share price dictates more of the index's movement, completely regardless of the company's actual market value. By contrast, the S&P 500 and the tech-heavy Nasdaq Composite use market capitalization weighting. Under this mathematical rule, larger, more valuable corporations exert a proportionally heavier influence on the index's daily final score. By tracking hundreds of distinct valuations simultaneously, these indexes smooth out isolated corporate failures and provide a reliable, real-time barometer for the health of the broader economy. The math governing these stock prices relies on the exact same present value logic used to price bonds. An asset is worth the present value of the cash it is expected to pay you in the future. This chart breaks down the specific cash flows for an equity investor. If you hold a share for a set number of years, your total future cash received equals the expected dividends collected during your ownership, plus the final expected selling price at year N. Unlike a bond with a fixed maturity date, a corporation can operate indefinitely. The potential stream of dividend payments theoretically stretches infinitely into the future, creating a unique valuation challenge. Because we cannot predict an exact final sale date or price decades away, the current market value of a stock is completely tethered to investor expectations of those future payouts, rendering a company's historical performance mathematically secondary to its expected future. To solve for an infinite timeline, analysts use the dividend discount model. This formula collapses an endless stream of growing dividends into a single present-day price, using three inputs: next year's expected dividend, the required rate of return, and the expected growth rate of the payouts. If a company pays a $2 expected dividend, growing at a steady 2% a year, and investors require a 7% return, the math outputs a precise current stock price of $40. Watch what happens when macro conditions shift, if interest rates rise across the economy, or if investors perceive higher risks in the market. They will demand a higher premium to hold the stock, pushing that required return from 7% up to 9%. The expected dividends haven't changed at all, but because investors are discounting those exact same future cash flows more heavily, the company is instantly repriced down to $28.57. Stock prices fluctuate constantly, precisely because this discount rate is a moving target, directly tied to real-time shifts in investor psychology and macroeconomic data. Every time an earnings report is released or a central bank adjusts interest rates, the market immediately updates the inputs for expected dividends, growth, and risk in the valuation model. This rapid processing speed is the foundation of market efficiency. In modern finance, algorithms and institutional traders digest new public data and update prices across millions of shares in fractions of a second. If current market prices immediately reflect all known data, the only variable that can move a stock price tomorrow is a truly new, unpredictable piece of public information. Because future news is unknowable by definition, it is mathematically difficult for active portfolio managers to consistently outguess the market over long timelines, which explains why passive, low-cost index funds so often outperform active trading strategies. That mathematical baseline holds up when markets process data rationally, but human psychology and herd behavior frequently override the valuation formulas. This chart illustrates a market bubble. Notice how the market price climbs aggressively away from the dashed fundamental value line. Blind optimism and speculative buying drive the asset's price far above what the underlying dividend and growth math can actually justify. When that speculative confidence breaks, the inevitable correction appears as a vertical crash. The market price violently snaps back to align with its actual fundamental baseline. These psychological detachments are highly dangerous. Overinvestment during a bubble leads to massive capital destruction during the crash, which can freeze credit markets and severely damage the broader real economy. Navigating equity markets requires reconciling the mathematical realities of long-term compounding with the psychological chaos of short-term trading. This historical graph isolates the risk. The highly volatile line representing one-year holding periods shows unpredictable swings between extreme gains and severe crashes. However, when extending the investment timeline to 25 years, the returns smooth out into a remarkably stable trajectory, drastically reducing a bad year's impact. Time serves as a natural buffer against volatility, but equity investing is never entirely risk-free. As long as you remain a residual claimant, you are fundamentally carrying the structural risk of the entire enterprise. Please remember that the historical data, valuation models, and market mechanics discussed in this presentation are strictly for educational purposes and do not constitute financial advice.